US Fed has finally drawn the roadmap for tapering off of QE. As I had mentioned in my presentation yesterday, June 19, 2013 would be the day when they finally announce, and so it has happened. Curiously, just a few minutes before the Fed decision, top analysts on television kept on saying that they would expect Fed to maintain its stance on monetary easing, and it would be many more meetings before they even decide about tapering off QE. They cited the slowing growth in the data emanating out of the US. I clearly mentioned in my presentation that the ground reality showed that the US data had improved dramatically to the point that Fed was now in a position to signal tapering off of QE, and so it has drawn a timeline, a graph of the road as it sees going forward. Some analysts say that hey, anyway they expected to Fed to start tapering off like end of the year, December. Now in this case it seems to be they would start tapering off in September. It's just a few more months. What difference does it make? Well, it makes a tremendous difference because the market will start factoring in the tapering off of QE right now. Some feel that, well, it was just the market reaction. Dow falling over 200 points yesterday was an overreaction. Asia opening tremendously weak today was an overreaction, and this would all correct itself over a day or two. I don't think so. I think this is the beginning of a tremendous reaction. If bond yields of over 10 years are going to cross 3%, better expect a reaction from the equity markets. Not only do I expect Dow to close below 14,000 by end of August 2013, I expect the Indian Nifty, which is already reeling under tremendous pressure, to close below 5,000 by end of August 2013. The Indian rupee is getting battered, and I expect it to go towards 62, 63 by end August 2013. I was very surprised that in India, when the rupee opened for trading, it was quite obvious that it would react negatively, and there were no statements which came out of the finance minister's office trying to cool the investors, trying to soothe their nerves. Even yesterday, what people, and I'm talking about international analysts and commentators, were only expecting Ben Bernanke to soothe the nerves, not to say anything dramatic. They felt that the markets had already been rattled and Ben Bernanke would do nothing to rattle the markets further. Then why did he hold this conference? And what was a press conference about? They have obviously missed the point. And if the analysts, top people, cannot see this in advance, they cannot see it until a few minutes of the Fed decision, then how are they going to do their asset allocation? I mean, we people have to understand that investing is a game which requires immense insight, and you need to be able to predict things much before they actually transpire. If you cannot see things even a few minutes before the event is about to happen, then how are we going to go forward? Even today, there's a tremendous amount of denial. Lots of people, analysts, commentators feel that the markets have overreacted and nothing further is going to happen. I think they are going to be in for a tremendously rude shock. Markets are going to correct sharply all over the world, and if they're saying that just by preponing the tapering off from December to September will not have any material impact, they are sadly mistaken. I don't know why are we able to bring these people on and be misguided from them from time to time. The Dow is going to go below 14 by end of August. Indian Nifty is also going to follow suit, and so is going to happen with various Hang Seng, the Nikkei, and so many European indices. Globally, there's going to be tremendous wave of selling, and I do not think that this is a one-off event. It's not something which has happened out of the blue. It's not an overreaction. It's the beginning. It's a very clear indication of the end of quantitative easing, end of the liquidity tap that Fed had opened, and the markets are definitely going to react in that direction. It is definitely a market moving event. Yesterday's announcement will have tremendous repercussions, and liquidity flows, especially to emerging markets, are going to start drying up. Definitely, it would be a matter of great concern if the emerging markets and the governments do not take concrete steps to revive the economy. They do not take important steps to stem the fall in their respective currencies, because this is going to lead to higher import values, is going to lead to import aided inflation, which will throw their growth trajectories and projections off track, bringing down the GDP growth down even further.